That is the sound of the Medic's Money financial bleep going off, which can mean only one thing. Today, we are answering your questions. These are questions from our YouTube comments section or that people have emailed us in. So we love doing these episodes. Hope that you find this episode useful. We're going to be covering, can you hold cash and stocks inside your lifetime ISA? And we broaden that out a bit to start to think about, when should you hold cash in your lifetime ISA, or should you put it in stocks and shares? And we present some data about that. We talk about the tax treatment of gift aid, and does NHS pension contributions reduce your adjusted net income, which will be relevant for any of you that are struggling with that tax-free childcare issue. I hope this helps. If it does, don't forget to hit the subscribe button, the like button. You got more questions and you're watching on YouTube? Drop them in the comments. Not watching on YouTube, send us an email and we will try to take your questions. We're going to do more of these Q&A episodes because you've told us that you find it useful. Back in the studio with my colleague, Dr. Ed Cantello, doing our favorite type of episode, actually, which is questions and answers. And we haven't done one for a while, but we had some feedback that you guys really found our question and answer episodes helpful. We love doing question and answer episodes because that's literally how Medic's Money started, just helping our friends on the ward around answering questions and things like that. If you want to ask a question, YouTube comments, amazing place to ask a question, and we pick those up periodically. You can also email us a question. If you're on an email list and you get an email from us, just hit reply with your question, and we try to pick up ones which are helpful to everybody. So if you've got a super question, like a super niche question, like I live in Denmark, but I'm planning to migrate to Australia via Ireland, what should I do about my tax? Probably not going to answer that one because it's pretty niche. But if you've got a question like, should I invest in a stocks and shares LISA or use a cash LISA? Applies to lots of people. We're going to take it, if that makes sense. So love to get your questions. Let's just fire straight into these questions. First one comes from a video on YouTube, which says, from Robbie Kerry 4500. Hi Robbie, thanks for your question. Quick question on LISA, not for me, too old, but my offspring might benefit. Does a lifetime ISA have to be only one type, e.g. cash, or could you have a LISA that is part cash, part well diversified passive investment funds? Thanks very much. Ed, what you got?
Yep. So, like you said, Tommy, great question. For LISAs, lifetime ISAs, you can hold them as cash LISAs. You can hold them as stocks and shares. You can have LISAs as well. You can have a combination of both. You can have more than one LISA, by the way, but you can only set one up and pay into one each tax year. So you can't have multiple LISAs, but you could have a cash LISA in one tax year and then set up a stocks and shares LISA another, or you can have a combination of them. That's fine. There were some changes to the ISA rules in April. One of the classic, or one of the best changes they're going to make is that you can set up multiple types of the same ISA in the tax year, but that still doesn't apply to LISAs, okay? So you can have multiple LISAs, but still, even from April, you can only set up one each tax year, okay, up to the age of 40. And on that note, Tommy, we've actually got a couple of LISA questions. And the next one I'm going to ask you. Tommy makes a fair point about cash not being inflation proof when it comes to Ed's LISA. However, had you factored in the government 25% bonus in addition to any interest earned? Will be good to hear if you're able to transfer it to a stocks and shares LISA.
So basically, this is like cash versus stocks and shares in your lifetime ISA question. Before I answer that, just a quick recap, because if you're not aware, lifetime ISAs can be a really useful vehicle. The government will top up to 25% of your amount that you put in, and the maximum that you can contribute in any one tax year is £4,000. So if you put £4,000 in, the government will literally give you an extra £1,000 for free. I think the root of this question comes from a slight misunderstanding. You will still get that government top up of 25%, whether you hold your lifetime ISA in cash or if you hold it in stocks and shares, or if you hold a mix like Ed just described. So I think that was the root of the question. But the wider question is, should I hold cash or should I hold stocks in my lifetime ISA? And the answer to that really depends on why you have your lifetime ISA, because some of you will have your lifetime ISA in order to facilitate purchasing your first house. And of course, the government giving you 25% of free money up to that limits that I discussed is kind of a no-brainer. So if you need your lifetime ISA in the short term, and by short term, I would say less than 5 years, then not advice, but what I would do is hold cash. Because, well, the reason why is because of this chart, which if you're watching on YouTube, what we have here is the reason why lots of times you might hear, oh, how long are you going to invest for? Less than 5 years, okay, you probably shouldn't own 100% stocks portfolio for less than 5 years. The reason is because of the chance of losing money. So on this chart, it shows between 1950 and 2022, if you held a portfolio for 1 year during that time frame, what would be your maximum gain or your maximum loss? So if we look at the green line for stocks between 1950 and 2022, if you held it for 1 year, your maximum gain could be 47%. Happy days. But your maximum loss could have been minus 39%. Not ideal. So let's say, imagine you hold it for 5 years, the mystical 5 years that everyone talks about. Well, then the numbers start to look a lot better. So if you held it for 5 years, your maximum gain would be 28%. Happy days. And your maximum loss would be minus 3%. So much, much better. Let's say you hold it for 10 years. Then the numbers start to look even better. 19% gain versus a 1% loss. And historically, between 1950 and 2022, in any 20-year period, if you held a portfolio of stocks, and I think the definition of stocks is holding the S&P 500, which is essentially American stock market, you would have never lost money. The maximum gain would be 17%, and the maximum loss, well, there isn't one. You just have gained 6%. The take home from this graph is that the longer you hold your investments for, subject to other factors, the less risk you have of losing your money. And 1 year is pretty risky. 5 years starts to look a bit better. 10 years, even better. 20 years, brilliant. So that's why we kind of say if you need the money in 5 years or less, you probably should not look at 100% stocks portfolio. So yeah, I mean, I have a lifetime ISA and I hold 100% stocks in there because I'm not going to use it to buy my first house. I don't need it for at least 20 years. So why would I hold cash in there? Cash is being destroyed by inflation, the value of inflation. If you've watched any of our YouTube videos, you will realize that. So I hold 100% stocks. But if I was going to be using my lifetime ISA to buy my first house, I probably would hold at least most of it in cash.
I mean, the other part of that, that question was more of a statement. Would be good to hear if you're able to transfer it to a stocks and shares ISA. Just for people that haven't listened to our previous podcast where I referenced that. So I also have a LISA. I have a cash LISA, and the reason being for the cash LISA is because, as I admitted, hands up, I kind of set mine up quite late in the day. Basically, the last day I could set up a LISA, I did, and in that short time frame, I could only set up a cash LISA. The second part of that question was, can I transfer it? Well, good to hear if you're able to transfer it to a stocks and shares LISA, because I talked about my goal was to do that, which I'm still going to try and do. I'm going to wait until April, so I haven't looked into it fully yet. But just like you said, Tommy, I agree. I think stocks and shares LISAs are much better, in my opinion. I think I'd much rather, have a stocks and shares LISA. I shouldn't say the better. I personally would rather have one. I've got a cash one right now. I agree. Stocks and shares, definitely better, and for the reasons you've just gone through.
Yeah, at the end of the day, anything in investing is about matching your goals to the risk and your desired return. And I think if you need the money in less than 5 years, I've just shown you a chart which shows you that probably it's a bit risky to be investing for less than 5 years, but more than 5 years, like me and you, we're just going to use it for retirement. The numbers tell you what to do. So investing should be data driven, evidence based. It shouldn't just be guesswork. So stop guessing, start using the data. I love that data. So that's why I constantly show that graph. You mentioned transferring ISA. We were just talking about this before we came on, that I have just transferred some of my non-lifetime ISA, just my stocks and shares ISA, from one provider to another, just consolidating a few things and reducing the fees that I pay. A significant amount of money has gone from my previous ISA provider, but it's just not arrived at my new ISA provider. So if you've ever had that kind of brown trousers moment when you're transferring ISAs between providers, let me know in the comments and I'll keep you informed, because I've literally got a fairly good chunk of my net worth somewhere in the ether. And Ed was just saying, like, we're so used to instant transfers. Like if I send Ed some money in my bank account, it gets there almost straight away these days. But my ISA funds are out there somewhere on the way from one provider to another, which is kind of exciting. So yeah, let me know in the comments if anyone else has ever transferred. Just tell me it's not just me, because first time I've moved, like it's a reasonable amount, but anyway. Move on. So this was on one of our YouTube videos where we said, is cash an investment in 2023? Actually, right, this is quite an interesting video because we recorded this at the start of 2023 and everyone was talking about the fact that you could now get 5 or 6% interest rates at the bank. Should I sell my entire stocks and shares portfolio and put it all in a high interest savings account at 5 or 6%? And we basically said, No, we're not doing that. We're just carrying on with our plan, which is to dollar cost or pound cost average every month into a well-diversified, low-cost passive tracker portfolio. And everyone thought we were crazy. I did a follow-up actually about the returns that we got from that strategy last year. And you can probably see from the slightly smug grin on my face that our strategy of doing nothing worked out pretty well. And I think that just reinforces the fact that historically cash has always underperformed stocks in the long term. And when there's a panic on, like last year when interest rates are out of control, there was a war on and everything, it's easy to panic and retreat to cash. If you'd retreated to cash in 2023, watch my video and you'll see just how much retreating to cash cost you. And it's not just a one-off, it's been like that way for a long time. So it goes back to using the data. But on to David Jones 5878's question about that cash investment in 2023. Can you put money into an already opened lifetime ISA after your 40th birthday? I reckon David Jones might be kind of our kind of age there, mate. Just after 40.
Yeah, absolutely. Yeah, just it's the best place to be. Just early 40s, and definitely you can, because as I say, I set my ISA up when I was 39 years and 364 days old. So I set my ISA up, and you can definitely put money into your ISA. You can do that up to the age of 50. And take advantage of the 25% bonus each time. Before the age of 40, you can set up a ISA. After the age of 50, that the ISA is just fixed. Okay, so age of 40, up to age of 40, set up a ISA. Up to the age of 50, you can put money into your existing ISAs. From the age of 50, it just sits there until the age of 60, when you can start taking the money out.
Exactly. And when I first opened my lifetime ISA, I had hardly any free cash flow. I was paying down on my student debts. I was earning a relatively low salary as a junior doctor. I was putting in like tiny amounts into my lifetime ISA. It felt pointless. Recently, I've been putting in much more. And if you're between 40 and 50, that is a prime time to start really ramping up your contributions to that lifetime ISA. And for every pound you put in, the government gives you an extra 25% bonus. Literally free money. The only caveat is you can't get it before you're 60. So if you're between 40 and 50, just turn up those contributions if you can. Next question is definitely 100% for you, mate, because it's about tax. It's on your really useful video, which was called on YouTube called UK Income Tax Made Easy. Got some great feedback and got some great questions in the comments. First question, great video, explains the tax calculations nicely. Could you do a section on the impact of gift aid for higher rate taxpayers in future, please, including readjustment of personal allowance for higher earners that start to lose personal allowance, please? Great question.
Yeah, it's a really good question, and I'm going to give the answer to that. I'm going to try and make it as simple as I can. Gift aid payments to charity, they provide taxpayers with tax relief from the charitable donation. What they are, they're deemed to have been made net of 20% basic rate tax. Okay, so that's the hard bit out of the way. Okay, because what does that actually mean? What does that mean in practice? Imagine I make a donation to charity. Essentially, everyone then pretends that I paid 20% tax as well as that donation. Okay, that's just how gift aid starts to work. Imagine, it's pretty easy if I do it in numbers, okay? Imagine I donate £800 to charity, and I tick the gift aid box. Okay, what happens? Firstly, the charity physically receives my £800. Everyone basically pretends that this £800 has been paid net of 20% tax. Okay, just pretend. Okay, I've only paid £800. I've not paid any tax, but everyone pretends that I paid it net of 20% tax. So it's deemed that I've paid £1,000 to the charity, of which 20% has gone in tax somewhere. Okay, of course I haven't. I paid £800. But I'm deemed to pay £1,000, and that £1,000 is called the grossed up amount. So £100 is called the net amount, £1,000 is that grossed up amount. HMRC will then pay over this pretend 20% tax that I paid to the charity. So I pay £800, HMRC pay £200, and the charity receives £1,000 in total. Okay, so that's the first way gift aid works. So I'm paying £800, the charity actually is going to receive £1,000 because HMRC will then top up that amount. Okay, so that's quite nice for the charity. They're getting money from me, they're getting money from the government as well. What about tax relief? So first of all, if you're a basic rate taxpayer, sadly there's no further tax consequences. You don't get any tax relief if you're a basic rate taxpayer, or if you don't pay any income tax at all. But if you're a higher rate or additional rate taxpayer, you can also get tax relief on that charitable donation. And the way it works, nothing to do with, in this case, this bit at least, nothing to do with the personal allowance. The way you get tax relief, it's done by extending the basic rate band, and if applicable, the higher rate band as well. Okay, so if I'm a higher rate 40% taxpayer, usually £37,700 of income is taxed at 20%. And then above that, I start paying at 40%. So the way the government gives you tax relief on that charitable donation is it will increase that basic rate band by your grossed up amount that you've paid to the charity. I'm a 40% taxpayer. £37,700 of my income is taxed at 20%. You add on your grossed amount of charitable donations. So in my previous example, the gross amount was £1,000. So I paid 20% tax on 38,700 rather than 37,700 because that amount's gone up by £1,000. So that £1,000 that I've allegedly kind of paid to charity, even though I've only paid £800, that £1,000 is basically means I get £1,000 of income taxed at 20% rather than 40%. So basically, even if you don't want to think about the calculations, even if I've lost you there, think about it this way. If I'm a 40% taxpayer, I get a tax relief of 20% of my charitable donation grossed up. So in this case, pay £800, that's going to save me £200 in tax. And if you're an additional high rate taxpayer, you actually save a little bit extra. If you're an additional high rate taxpayer paying 45% tax, you basically save £250. If you just remember these two things, first of all, you pay an amount of money to charity, let's say £800, the charity actually gets £1,000. Secondly, if you're a higher rate taxpayer or additional higher rate taxpayer, you get tax relief on that £1,000, that gross up amount. So hopefully that explains a little bit about how gift aid works. Now, the second part of this question mentions about the personal allowance, okay? There's a concept in tax called your adjusted net income, all right? And that's important because that then you use that to decide how much personal allowance you get, or for example, if you're eligible for the tax-free childcare scheme. And the reason why gift aid is important here is because you can deduct any grossed up gift aid donations from your taxable income to reduce your adjusted net income. That is, your adjusted net income is your net income reduced by the gross amount of any gift aid payments. So if, for example, I had an adjusted net income of £100,000 and I was going to get some additional income, which takes me above £100,000, which means I'll start to lose my personal allowance, for example, then any charitable donations that I made, once you gross them up, you can deduct that off your adjusted net income, which means I'm less likely to lose my personal allowance.
I think the next question might help to kind of reinforce some of that knowledge that you've just dispensed, because it's kind of about a similar thing. So it was in response to a YouTube video called NHS payslips, taxes, pensions, and more. Sounds like a pretty exciting video. Hi, thanks for this video. Regarding tax-free childcare and the 100,000 threshold at which this is lost, do NHS pension contributions help to reduce the adjusted net income?
Yes, absolutely. This is a great question. And the reason why we kind of put this in with the previous question is, of course, they both gift aid and pensions, they do reduce or do affect the adjusted net income. Okay. So I appreciate this is very, it can be complicated to understand, and hopefully I haven't lost everyone. The point is, as I say, adjusted net income is your taxable income, and then you make some certain adjustments to that to then get your adjusted net income. And it's your adjusted net income that determines if you're going to lose your personal allowance, and also if you're going to lose that tax-free childcare that the question asker mentioned, okay? And it's at that £100,000 of adjusted net income that you start to lose these things, okay? So if you start from the basis that your adjusted net income starts with basically your taxable income, then the NHS pension contributions, they do help reduce your adjusted net income, because you take your taxable income and your NHS pension is included in that taxable income. So you've got your gross salary, for example, your NHS pension is taken off that to then get to your taxable income. And that is the starting point pretty much for your adjusted net income calculation, okay? Then a couple of other bits and pieces affect that adjusted net income. One is grossed up gift aid contributions, which is exactly why I've talked about that before. The other one is the gross amount of any personal pension contributions eligible for relief in that tax year. Of course, you have to be really, really careful about making any personal pension contributions, because that leads into all this kind of worms about the annual allowance and all sorts of horrible things in terms of the pension, which, I know that we've talked about quite a lot of Medics Money, so I'm not going to labour the point. In answer to the question, yes, the NHS pension contributions, they do help reduce your adjustable net income because they reduce your taxable income, and that's a starting point for this calculation. The other thing to say, and this is my last thing, I promise I'll be quiet now because I'm probably losing everyone, but we have a lot more information on this on our website, on our marginal rates article. So if you type in Medics Money marginal rates into Google, you can find it on our website, okay, medicsmoney.co.uk. all about this.
And you should type that into Google if you are even thinking about doing extra locum work, because you'll see that the taxes at the marginal rates, if you get stung by these marginal rate tax traps, it can mean that doing extra work actually costs you money, as in you receive less benefits than you would have had you not done the work. Absolutely nonsensical. But the fact that whoever asked this question is aware of this issue is really, really great. Like, that's why me and Ed are here and everyone else is here doing it, because you are aware that if you get near that 100k and you've got tax-free childcare, you need to have a serious think about whether doing any extra work at all makes any sense. And there are a few little tricks that you can use to get that adjusted net income, which Ed mentioned. Obviously, gift aid covered that extensively today. Extra contributions to a pension, just be careful about that with the annual allowance tax. It's definitely possible to do that, but you probably need to get professional advice if you're going to be going down that territory. But the fact that someone's aware of this makes me really happy, because, you know, the tax system extra work should equal some extra income, and there are certain areas of the tax system where it makes no sense and you need to be aware of them. Otherwise, you're literally going to do extra difficult overtime work and receiving nothing for it, or even worse, losing all your tax-free childcare. So great question, mate. That was awesome. We love doing these episodes, so if you want more of them, let us know in the comments, and don't forget to leave us a review, subscribe. If you do that, it helps other people to find our podcast, and we can all learn and improve our financial health together. Keep sending us questions. We're going to do more of these videos, but for now, on that pretty heavy question, I think we should wrap it up. Thanks for listening or watching. Look forward to answering more of your questions next time.